First up, retail investors can now access a broad selection of leading global index benchmarks at institutional pricing. GinsGlobal Index Funds is the first dedicated unit trust firm offering a comprehensive range of offshore index funds to the South African market. To discuss how the GinsGlobal Index Funds work is Director of the company, Lisa Siegel. Thanks very much for your time.
Thank you.
Well, let's start with the story as it is with GinsGlobal and what you are doing differently in the market.
Well, we've actually been here since 2001, so we're not a new operation. And what we've done is we've built up bulk assets, mainly with the institutional funds. We've offered retail before, but not at these low institutional prices. So what we've decided this year, given that indexing now I think is taking off in South Africa for the first time, it's been here quite a while, but I think the South African market is woken up, especially as a result of Dave McCarthy's paper on retirement reform and the costs. So your retail investor is now looking at these products more closely and demanding them from your asset managers and from your insurance companies. So we've decided then, as a result of all this pent-up demand, to give the retail investor better fees at an institutional price.
Well, let's talk about those better fees, because you seem to have come in very competitively and shaved off a significant cost for the retail investor.
Yes. Well, we've always wanted the South African market to have a better deal. You know, something in line with what you see in the offshore market or in the US, where we've also got an office. So we sort of aligned our interests with those markets now. We're not actually competing in the South African market, we're competing in the offshore market in terms of fees.
So as a retail investor, you can enter into the products that you're offering, but you're getting exposure offshore.
Correct.
Where exactly are you focusing those offshore components?
It's in the developed markets. So you would have the benchmarks we use is a bit more broader. So we use the MSCI World, which a lot of the asset managers benchmark their performance to. And we've got a range of equity funds and bond funds and property funds. And we've also have an emerging market fund.
When you say developed markets, we're talking Europe, US?
Correct.
Do you believe that that's where
Japan.
Value will be found down the line?
The US has had a strong run. Personally, I'm looking at Europe because that hasn't run so much as the US market. And, you know, that still had a few structural problems. So I think those markets haven't seen such good returns as the US lately. So we've got a European equity fund and a European real estate fund.
You're enthusiastic about Japan. You've mentioned it a couple of times. You think that the quantitative easing that they've embarked on is going to yield results?
I hope so. It hasn't so far, but...
Well, the GDP number was better than expected.
Yes, that's correct. So, well, you can also get, the most broadest benchmark where a lot of the asset managers do use us is the MSCI World. So that's like about 49% to the US, it's got Japan, it's got Europe. So if you take that one benchmark, you're covering most of the 23 developed markets. So that's probably a best bet for a retail investor to look into.
Europe is now out of a recession, almost steady as she goes. Do you think that offshore, that's another area that we're going to see a lot of value? You've mentioned it as well.
Yes, and in the property
And
sector.
Europe is a big place. How are we going to play it?
I know Merkel's just been re-elected, so Germany obviously is a forefront. I still think there's some value in some of the Portugal, France. They haven't seen those markets really have a run at all. And then obviously the UK, which is looking good at the moment.
Your play, as you say, is developed environment. Do you think that the party for emerging markets is over?
No. I've seen our emerging market actually this year has been very flat and actually very negative. We've actually seen recently, since the Fed Reserve, you know, their tapering decision, we've seen emerging markets run. Yes,
and this could be the way forward because there's
Correct.
still easy money out there.
Correct. So yes,
the trend is set to continue, and investors are going to be looking for yield.
Yes, I think emerging markets now. A lot of our clients are about 3-4 months ago they've pulled out of emerging markets when the currencies, you know, obviously didn't do so well, and we've seen the last actually week a lot more money going into our emerging market fund.
South Africa itself, now there's a big debate going on at the moment. There are pockets of value. The rest of the market is looking very expensive. how would you be playing the local environment?
It's a good question. You know, Bron, we mainly focus on offshore because I think I would probably going against the grain to be an index supporter. But here, I think, given that the market has had a very good run, you would probably look to be a stock picking market now. You know what I mean? It's and I'm not an active investor.
Well, exactly. You are in the passive environment,
Correct.
and the discussion that I'm going to be having with Henry van der Venter in just a moment is active versus passive, or rather, you know, what you are paying the active managers for. Let's get you to weigh in on this argument.
Well, I was actually discussing with Henry earlier before we went on the show, is locally I do see there is an argument for active here, given the way our market is constructed. You know, you've got about 5 big shares comprising of about 49% of the market, whereas overseas, in a development market, it's more efficient and you've got more information. So indexing works overseas. I mean,
are you saying that it doesn't work in South Africa?
It does, but there's value to have more of a core and explore or an active and passive blend in your portfolio here. I can see that. There's definitely more in an inefficient market where South Africa is, where you don't have, like in the US, there's not so much information in some of the markets. I do see there's value having an active and passive blending portfolio, which a lot of the managers are actually doing now. Overseas, the markets are far more efficient and the fees are far more lower. So there is, last year, actually, if you look from Vanguard, 50% of all the flows went into some kind of ETF or index product. The biggest fund in America is not a Templeton or a Fidelity, it's actually the Vanguard S&P 500. It's
Lisa,
a pure index tracker.
Let's come back to what you're seeing on the ground with a retail investor in South Africa. Are they brave enough to look offshore to utilize these vehicles? Are you seeing a pickup?
Well, I actually feel, in a way, a little bit sorry for the South African investor, because I think in 2001, 2002, when the Rand was 11 or 12, they went offshore. You know, everyone panicked, went offshore, then the Rand strengthened, and you've had double whammy, because you've also had the markets not running so well overseas as opposed to South Africa. So you took your money offshore at 11 or 12, and the market wasn't doing so well offshore as well. So the South African investor has been very burnt by going offshore.
You can't, well, the lesson there is don't try and time the market, isn't it?
I think
or the Rand.
No, for me, I would advise the South African investor, it's called dollar cost averaging, or here you would say Rand cost averaging, is don't look at whether it's a currency issue. You should actually look at your financial plan. And South Africa makes about, 1% of the world markets. For me, personally, I can't justify having 99.9% of my money in a 1% market. You know, even the Americans would have some money offshore, offshore as opposed to being in the States. So the rule of thumb would be you should have some money offshore as an asset allocation model, not about the Rand or, the Rand or the market. From an asset allocation model, you should have some money offshore.
But what about the timing now with the Rand at current levels?
There's no good timing. I would suggest...
Is it not particularly bad timing now?
No, I think you should have money offshore. I think the issue is probably a better timing to go offshore now because the local market has had such a good run.
So take some of that money and deploy it into...
Yeah, I would actually take some profit because, here people actually don't understand why your market is so high and they think it's going to be a bubble and they're waiting for a market correction. I think you've seen a good run in the US, but you haven't seen a good run in some of the other developed markets offshore, like I said, as Europe or Japan, the emerging markets, China, Brazil, Russia. You haven't seen the same kind of run in those markets that you've seen in your local markets.
But in the translation, it would be beneficial to bring money from offshore to South Africa just to benefit from the exchange rate at the moment.
Or you could say it the other way around. If you're going to, it's your view on the Rand, is it going to strengthen or is it going to weaken?
So you think it's going to weaken from these levels?
don't. That's a difficult
It sounds
one.
as though you think it's going to weaken.
What I would suggest, Bronwyn, is to do a Rand cost, dollar cost averaging. So if you've got a lump sum, maybe don't put it all in at once. Put in an amount every month. That's
Absolutely.
how I would suggest it. So then you're getting the currency issue, so you can take over at 983, I think it is today. Maybe you'll take it 960 the next month. And then also your NAV, your net asset value, would also be different. So that's what I advise the investor. Yes, definitely to look offshore, because the market offshore, you've got quite a few undervalued markets there. As I said, Europe hasn't had the run that the US has, or Japan, and your local market has run considerably. So that's a worry for me.